Bam, welcome back to Talking Options. So you are interested in learning how to trade the market. You've already started learning the basics of options, right? But you're still trying to figure out the difference between a call and a put. And you're like, Samantha, I want to get my hands dirty. Give me an option strategy that I can learn right now where I can start to get hands-on experience. I'm so happy you asked that question. That's what this video is all about. We are talking about the cilantro to your guacamole or your guacamole covered calls. Now, the reason why I love covered calls is it's very simple to understand. Let's say, for example, I own a stock outright, Apple, right? And Apple is rallying to the upside, but I want to protect myself because I believe that Apple may go down in the next 2 weeks, maybe due to news or an earnings report that came out. Maybe they didn't do too well. So I want to protect myself to the downside. I want to make some money, even though I own it outright, and I believe that in the long term, it's going to go up. Well, in this case, I would do a covered call. And so a covered call is basically me saying I'm going to write a call to protect any movement to the downside. In this case, we're talking about Apple, right? So I actually found a really good article. Let's see if I can pull it up here, that talks about Apple and a trade that you would be able to do with a covered call. So let's say, for example, I bought Apple back in 2016 when it was trading at $100 a share. Yeah, I wish I did. So it's trading at $100 a share, and right now it's at 160. Let's say it's at 160, right? That's what this article is saying. So that would mean that I have about $60 gain per share. That's about 60%. Now I want to protect myself to the downside. So I'm looking at writing a call, and I want to do it at the strike of 200. So I'm basically saying that I believe that the market is going to remain below $200 by expiration. And in this case, they have the expiration of July 19th, 2019. So that's actually coming up. So you can see that we have the bid and ask circled here. This is circled because you have to figure out what is going to be your premium that you collect. Now, usually if you're trading on Thinkorswim, they're going to tell you how much premium, but you're going to get the mid price here. So let's say that's $3.85. That means that that's immediately going to come into my account when I write this covered call. Is I'm going to get $385, saying that I believe that the market is going to stay below 200, right? So let's say, for example, we're in July and Apple continues to trade below 200. Well, that basically means that the call option is going to expire worthless. In this case, because I'm the seller, remember, I want it to expire worthless because the buyer is not going to buy me out because it remained under 200, which means that I get to keep the money that I collected, $385. Boom, shakalaka. Free money to my account, and I still own Apple. So I was able to make money on the downside move. Do you see how great that is? This is what I'm talking about, why we love options. You can't do a strategy like that in Forex or futures. And that's the reason why options trading is going to allow so many people to not only hedge their positions, but then also make money. I don't want to say passively, but oh my goodness, this is nearly passive. Like all you had to do was a covered call position against your stock. So this is great. Let's say, for example, though, that Apple closes above 200, right? So it trades above, we still collected $385, right? So let's say, for example, that the call option buyer buys us back out at $200 where we sold, right? That was our strike price, 200. Well, that basically means that because we collected $385, we give them back 200, or we pay them back out their 200. We still got $100. That's about $100 worth of a profit. This is what we're talking about when we say the greatness about covered calls. Because whether there's movement to the upside or downside, there can still be some sort of profit, even if the trade goes against us. Now, a couple of things that this article talked about that I like that you have to keep in mind is that you can choose any strike price or any expiration that you desire. So if you choose an expiration that is further away from the money and you are buying outright, of course, it's going to cost less. But if you're selling, you're going to collect more money because you have more time, right? So this is Now, one thing that I like about this article that they mention is here, you can choose any strike price or any expiration you desire. So you didn't have to choose July. It could have been August. It could have been September. Or you could choose something like weekly options where we're expecting a lot more volatility. You make your money quicker the closer the expiration is. So you, of course, can choose a longer expiration. It's just going to take more time for you to make that money, especially when you're buying outright. As you can see, it says it right here. The longer the expiration, the more money each option will pay out. The higher the strike price, the less money you'll receive. So these are just some key things to keep in mind with a covered call. Let's head over to the platform. See if I can pull up Tesla. Tesla is always very volatile. And if I own stocks outright in Tesla, I would definitely do covered calls on this because you can always expect a lot of volatility in Tesla as well as liquidity. So right now the market isn't open yet. It's one thing I don't like about the stock market. They don't open until 9:30. So we won't be able to actually see the movement right now. But you can see it's trading at $185 right now, right? If I own stocks outright in Tesla, going over to the trade sector, you can see this is the options chain. These are the different expirations that you have. One thing that I love about Tesla, you have weeklies as well as you have monthlies. So if you want to trade on a weekly basis, make that money on quicker every Friday, you can do that. But if you want to trade on a monthly basis, you can also do that as well. So I just want to show you what it looks like here, even though the market's not open. This is June 21st, 2019, so it expires in 18 days. If I own stocks outright in Tesla and I wanted to do a short call, you can see this is the call sector right here, bid and ask. If I wanted to do it at the money, you can see this is at 180 right here, right? So I want to say that I believe that it's going to trade at, I'm not going to do it at the money. I'm going to go in the money. I'm going to say that it's going to trade right now at 210, right? It's going to stay below 210 is what I mean. So right now, this means that I would collect $239 or $239 because this is one contract and there's 100 shares in that contract. So if I press confirm and send, you could see again, my max profit would be $239. That would be the credit that I receive. Of course, minus the commission, which is $1 in this case. And the buying power is awesome. It's only $1,842. So that's just an example trade of what you could do with a covered call if you own stocks outright with Tesla. You don't have to own stocks outright to do a covered call because technically if you're trading futures and Forex, and you buy it outright, well, you own it, right? So you'd be able to do a covered call even when you're talking about the euro or the Jap or the Japanese yen or the Aussie. You can still do covered calls on those positions as well. So this is a quick video on one key strategy that you options traders, beginners out there, could start to play with in your paper and simulated accounts. I'll see you guys later.